Thinking about interest rates and the frequent use of leverage in closed-end funds, how risky is the closed-end market right now, and what's your outlook for the future? How may actions planned by the Fed affect closed-end fund investors?
Certainly one of the main risks to closed-end fund investors is risk on levered funds, where we're seeing short rates go up and earnings get squeezed. So I'd say the main risk on many of our products is an income risk. But also, as we see the Fed moving rates higher, we anticipate the long end will move higher as well, which means you have net asset value risk. So many people have been looking to shorter duration type of products or looking for credit. So the combination of shorter duration and higher yield credit plays are what people are looking to.
Well, I think most managers are pretty conservative about how they manage risk and how they manage particularly their interest rate risk. A lot of managers have taken out very long-term leverage on their portfolios, and so they manage the duration incredibly tightly. And equally, I don't think anyone's saying that we're going to move into an environment where rates are going to be rising rapidly and aggressively.
So the closed-end fund market, from an interest rate risk perspective, we've seen for muni bonds a SIFMA rate hovering 85 basis points. Again, not crazy expensive. And so the financing for those funds that use it, it's easy to overcome with the long-dated bonds they use. We've also seen for those municipal bond funds, the durations averaging around a year ago of 10 and mid-change, and now the average national fund has a duration of 9 and mid-change. And duration, of course, is the sensitivity to interest rates for the average bond in the portfolio.
Always understand exactly what the fund is using for leverage, how much leverage it's using, and also understand that as short-term interest rates go up, as they seem to be continuing to do, the cost of that leverage will continue to go up. Does that make them more risky than normal? I would say not, as long as the investor understands what they're taking on.
And there are an awful lot of funds, particularly in the equity world, that aren't leveraged anyway, even if you are worried about that. But I stress again, I don't think one needs to be.